Hi, very good afternoon to all of you. We'll start with our presentation on monthly market outlook. If we look at globally today, the forecast for 2023 is fairly mixed. Some things looks good, some things don't look that good. However, while the headlines are negative in terms of rising inflation or markets making losses, the expectations are turning positive. Commodity prices have corrected significantly, and falling commodity prices is giving confidence. Inflation should start coming down in most of the developed world, US, UK, Eurozone, everywhere. As inflation is expected to come down, the expectation is that even interest rates will start coming down somewhere in second half CY 23. US Fed, which is the big setter of the rates globally, is expected to cut rates between December 23 and March 24. With inflation coming down, interest rate expected to come down, IMF has started upgrading outlook for global economy. World outlook has marginally improved, so has European outlook, so has emerging market outlook, and thanks to China opening up, even their outlook has seen a significant jump. There is interesting trend happening globally where manufacturing activity are either contracting or struggling to remain at the same level. But services activity are expanding across the globe. It's almost as if people are spending more money on travel and hotel rather than buying, let's say, automobiles. In this kind of uncertain environment, there's no surprise that investors are underweight risk assets like equity, like technology, and they are long safe assets like bonds, utilities, and cash. Coming to US economy, Fed has been struggling to rebuild their credibility and hence has embarked upon one of the fastest rising interest rate cycle in memory. However, Fed is not putting all the pedal on the brake. The liquidity is being withdrawn, but at a much slower pace. Fed added $4.8 trillion between 2008 to 2022. However, they have only taken out $400 billion in liquidity. So you have added $4.8 trillion, taken out only $400 billion. Clearly, there is not all-out fight towards controlling inflation. US leverage is probably compelling Fed to pursue a two-path stance. US total debt is $31 trillion. Their revenue is about $4.9 trillion. And the deficit last year was $1.4 trillion. Clearly, US cannot afford very high interest rate. Parliament of US has put up a cap on how much debt US government can raise. In the past, for more than 60 times, Parliament has revised the debt limit upwards. And normally, there is a lot of negotiation, including shutting down government while this debt limit is revised upwards. We believe that Nautanki is likely to start in very near future. The US government will go to the House and Senate asking for upward revision in debt limit, and House and Senate will try to put pressure back on government. Expectation that US will have to borrow large sums of money going forward is reflected into this chart. The public, which is on an average holding debt of about 49% between 1980 and 2021, currently is holding almost 100% of the debt. And it is likely to keep on going up as American budget remains in deficit and will have to resort to financing. Today, interest payment is one of the highest expenditure in American budget. Their cost is likely to be $853 billion in interest payment on about 31 trillion of debt in CY22. This will be more than the defense budget in 2023. In fact, the futuristic projection of US looks very, very constrained from a fiscal point of view. They have committed expenditure on defense, on social security and health entitlement, on interest payment, on non-defense discretionary. Effectively, US will be under tremendous pressure to keep interest rates low so that interest cost does not consume large part of the budget. In US, savings have declined significantly and credit card debt is threatening to cross a trillion dollar size. Clearly, savings are declining and credit card debt is growing rapidly, showing the leverage of American consumers. Fed is caught between devil and deep sea. If they raise interest rates, growth will suffer, recession will come. If they don't raise interest rates, inflation will continue to remain high and Fed's credibility will get hit. Some respite for Fed, despite very, very tight employment situation, the wage growth has started stabilizing. It's not inflationary in nature at this point of time. Within inflation, goods inflation is actually falling, but services inflation is continuously growing. Like India, all over the world, people are spending more money on travel and eating out kind of activity than buying consumer durable. The real challenge is if Fed starts cutting interest rates ahead of when it was needed, then it is possible that inflation could bounce back quickly. Today, inflation is on its way down as people are constraining their demand because of rising interest rates and tightening liquidity. But if the withdrawal of liquidity and raising of rates is reversed prematurely, then will inflation be back like in the 70s? The 10-year yield are already well below US Fed fund rate. Market seems to be discounting that Fed will be reaching peak of tightening cycle and will start cutting rates soon. That's where there is curve inversion in US market. Few days back, labor report came where America added more than 5 lakh jobs against expectation of more than 1.5 lakh jobs. That changed market expectation about US Fed future. Now they believe US Fed rates can go around 5.1%, and the rate cutting cycle may happen anywhere between December 2023 to March 2024. Obviously, Fed would not like market to run ahead of itself. In that context, Indian economy is doing reasonably well. If I have to describe budget, I think it's a Bahubali budget where finance minister like Amrendra Bahubali from one budget hit 3 targets. She increased investments by allocating 33% more, reaching to 10 lakh crore. She supported consumption by giving tax cuts of about 35,000 crore. And yet, it maintained the path of fiscal prudence. This budget is also Kal Aaj or Kal budget. Yesterday, we didn't invest in infrastructure as much. We didn't support our businessmen as much. This budget is trying to correct that. For today, budget is supporting growth, albeit with fiscal prudence. जितनी चद्दर लंबी हो, उतने ही पैर फैलाने चाहिए. Something similar is being adopted by the finance minister. And at the same time, we are taking care of the future by investing in green hydrogen and skilling of millions of people who are unemployed today. This right mix of correcting past errors and omissions, securing present growth rate, and investing for future truly makes this budget Kal Aaj or Kal budget. News headline in India has been fairly positive. Of course, there are some negative headlines here and there, but by and large, India is fairly positive in terms of headline messages. It's not that we are not linked to global economy. Of course, we are linked to global economy, and if global growth slows down, there could be impact on our economy through inflows. The momentum for both manufacturing and services sector continues to remain expansionary. Urban and rural sentiment seems to be improving. Rural sentiment is up as Rabi crop is turning out to be good. Soil has moisture. Water reservoir levels are higher than 10-year average. Availability of fertilizer and seed is better than last year. Put all these things together, Rabi crop is likely to be all-time high this year, which is supporting sentiment. Inflation is now coming below RBI's target level, upper range of target level of 6%. And for the next year, RBI is expecting GDP growth of 6.4% and inflation of 5.3%. Private sector is looking to invest, while all their announcement will not get converted into real action on ground. The announcements have started picking up. It looks like this time private sector and government will work together to revive infrastructure investments. Capital expenditure is seeking a new cycle led by industries like chemical, renewable energy, metals, electronics. There is also availability of finance to carry out capex, and both these things bodes well for Indian growth. The aggregate capex is expected to grow at more than 20%, reaching to almost 4 to 4.5% of GDP. This is a very interesting data. Indian factories are now becoming bigger and they are employing more people than before. Larger companies will have obviously size and scale, and they will be more competitive in the rest of the world. As economy is moving in higher gears, they require financing, and which is where bank credit growth, both for businesses as well as retail and personal loans, is remaining at a very, very healthy pace. More importantly, these banks are lending money to borrowers who are prompt in repayment. The gross non-performing assets of the bank are coming to a decadal low level, and whatever is left is reasonably well provided for. Banking sector is in a far better shape today than before. Normally, we have seen that capex cycle creates capacities and then it results into higher profit. We believe current infrastructure investment cycle, current investment cycle by corporates will result into faster profit growth next year. The GST collections are now averaging around 1.5 trillion rupee. Last month was no exception. It's a step up from 1.4 lakh collection, which we used to get before. As I mentioned, in this budget, the fiscal prudence is visible, and fiscal deficit of central government for FY24 is estimated at roughly about 5.9%. More importantly, there is a target of 4.5% over next 2 years. Essentially what it means, चादर जितनी लंबी हो, उतने ही पैर फैलाओ. Do we have challenges for our economy? Undoubtedly, yes. We have done better than the world, but our challenges remain. The one big challenge is India's trade account deficit. We continue to import far more than what we are exporting, and we really need to take care of our burgeoning trade deficit. How do we reduce import? Well, we have to ensure that people travel in India rather than outside India. Instead of sending our kids to Harvard and Oxford, we should bring Harvard and Oxford to India and let neighboring countries' kids and African kids come to study in India. Instead of paying $25 billion for import of coal every year, we should mine domestic coal. Today, we import large quantity of gold. $35 to $50 billion a year is spent on import of gold. If we can reduce this craze for gold, to that extent, economy benefits. And the final thing is trade deficit with China, which is running at a very, very high level and threatening to touch $100 billion. So if I can figure out a way to control dealing with China, then I should be able to manage my current account deficit well. Crude oil prices have softened. It's a welcome sign for India. This softness is driven by one, increase in production, and second, reduction in demand, especially in developed world. Now, as we believe rebounds is due in developed and emerging market, can this oil prices go up or will it remain here? That will determine what happens to our market. Everywhere the world has grown by exporting, and you could clearly see how countries like China, Japan, Germany became the powerhouse of exports. India continues to get very, very low percentage of exports. In goods export, our market share is 1.8%. In services export, we are somewhere around 5 to 6%. Like we have very high market share in infrastructure space, in exports, we should be able to copy or mimic China, Germany, and Japan in increasing our exports, which will be beneficial for growth. Our market today is impacted by non-budget event. Clearly, we must remember that India got premium valuation because our earnings growth was better than rest of the peers. Our governance standards were superior to our peers. And our commitment to green is also better compared to many other parts of the world. This combination of 3G, growth, governance, and green is reflecting into our premium valuation. Coming to debt market, economy is chugging along despite interest rates being hiked and liquidity getting reduced. If we look at US Fed post-labor report, there is expectation that Fed rate will peak out between 5 to 5.25 somewhere towards March, April 2023. And thereafter, there will be a series of rate cuts to ensure that by December 23, rate cut cycle can begin. Fed's desire of cutting interest rates will be driven by the fact that refinancing costs are jumping up, and many American investors are rightfully complaining, why are they paying price of higher interest rates? The cost of insuring against US debt has gone up as fear of acrimony over US revision of debt limit comes into play. In fact, Bank of America managing director said that one has to be cautious about US because of the debt limit, there could be delays and defaults on US government securities. In that context, India has given a reasonable budget. The fiscal deficit comes down from 6.4% to 5.9%, on its way to 4.5% by FY26. Clearly, this fiscal deficit will assure investors about a better future, and they'll remain invested in India for a longer period of time. The market borrowing of government securities is as per the expectations of the market at roughly about 11,80,000 crore. But this borrowing to pass through will require support from RBI. If RBI doesn't support, doesn't do open market operation, then raising 11,90,000 crore for the government will be difficult without RBI's intervention. The banking liquidity has continued to decline over a period of time from about 7-8 lakh crore worth of daily liquidity. Now, liquidity is somewhere around 2 lakh, 3 lakh crore. As liquidity tightened, interest rates have gone up. The headline inflation has now fallen below RBI's upper target range of 6%. More importantly, next year's inflation is likely to be 5.3% based on today's prices. If we look at from an interest rate point of view, normally US used to have higher real interest rates, and India many a times had negative interest rates. Today, it is exactly the opposite. US interest rates are negative from a real point of view. India has positive real interest rates, and the spread between India and US for interest rate differential is one of the highest in recent times. Where should one invest in today's environment? We believe the middle part of the curve, somewhere between 3 years to 7 years, look appropriate. They'll give you carry and at the same time not expose you to much amount of risk. Coming to equity, coming to debt funds, we continue to recommend Kotak Medium Term Fund. 68% of its portfolio is in AAA. About 25% is in AA plus and AA. The coupon of portfolio is about 8.2%. And while REIT InvIT portfolio has brought down some amount of the return, we still believe it is an attractive investment vehicle for long term. In order to take advantage of debt market, where interest rates are expected to come down by December 23 in US, one can look to invest in dynamic bond fund. This fund buys duration when it believes interest rates are going to go down and sells duration when interest rates are expected to rise. This dynamic bond fund works well for investors with a long-term horizon. Coming to make the case for state development loans, you get 25 to 50 basis point extra return when you invest in state development loans. And typically, state development loans, thanks to the credit mechanism, has a reasonable amount of security, as payment and servicing of SDL is normally done by the Reserve Bank of India by taking out allocation from the central allocation to states. The best way to play out fixed income this year will be to ensure that your investment time horizon meets with the portfolio duration. In the short term, money market fund, saving fund, low duration fund kind of fund can be considered by investors. For medium term, let's say above 1 year kind of time horizon, Kotak Corporate Bond Fund, Kotak Floating Rate Fund, Kotak Bond Short Term Fund, and Kotak Banking and PSU Debt Fund can be considered by investors. Over longer term, dynamic bond fund or a gilt fund or a bond fund will be appropriate. For investors who are looking for conservative risk return profile, hybrid funds will be appropriate. Kotak Debt Hybrid has given low double-digit return since inception. It has also generated better return than benchmark index. The same story is repeated with Kotak Equity Savings Fund or Kotak Equity Hybrid Fund. Coming to equity markets, well, in the short term, India looks expensive to rest of the world. RP is about 21 on a FY23 basis, whereas Brazil, China, and South Africa is at a substantial discount to us. Maybe this premium valuation is justified by the fact that our growth rate is likely to be higher than most of the peer groups for many years to come. FPIs who are looking to invest in cheaper markets like China, Taiwan, South Korea, Brazil, Thailand are taking money out of India and investing in those markets as valuations have corrected. This chart depicts the movement between Chinese equity market and Indian equity market performance. Normally, we have created a mirror image for each other with many times when Indian markets have outperformed Chinese market. One such incidence was the turning point of 2021. The Chinese market looked very, very cheap. Indian market looked very, very expensive. And people started taking money out of India to allocate towards China. Now that gap has narrowed down significantly. Hopefully, India will start receiving its share of flows over next couple of months. Valuation in India across the sectoral curve has started coming down as prices have corrected. Our premium to emerging market continues to remain high against an average of about 68% on MSCI India index. We are currently trading at 123% premium to emerging market. Clearly, our valuation premium needs to be justified by delivering growth, governance, and green commitment. The DII, thanks to all your help and support, has become major player. We are able to match foreign portfolio investors in a reasonably balanced manner, and this is reducing volatility in Indian equity market. Domestic investors' influence on equity market can be seen from this chart. In October 21 to June 22, FPIs were massive sellers. They sold 2,55,000 crore. But thanks to your help and support, we could buy 2,96,000 crore worth of equity. Net market only suffered 10% downside. Between July to December 22, FPIs and local investors both were buyers. Markets went up 15%. Currently, while FPI is on the selling side, domestic investors are regularly buying. Even though markets have corrected a little bit, it is not a cause of concern. Based on valuation, while we trade at premium to global peers, compared to our historical averages, we have come down little bit. And on a price to earning basis, we are near our historical average of 8.4. But on a price to book, we continue to remain relatively expensive. So our valuation, we are near historical average, but global valuation, we are at a premium. Market cap to GDP has corrected from 112 to 100, but our long-term average is just about 79%. If we see the results, the universe of companies which we track against estimated 11% growth in profit, the actual growth is about 7%, and hence results are little below expectation. Not by a substantial margin, but little below expectation. But within that, metals and oil companies have done great, while against 25% profit growth, they have delivered 28% profit growth. In financials, against 1% expected growth, it is -6% and hence below expected results. Nifty large cap indices is more or less in line with market and hence considered little bit above the market. This results in line with our expectation also creates a base for the market. It will be fair to say that next year FY24, there will be volatility, there will be a lot of up and down moves in the market. Please be ready for volatility through disciplined asset allocation. You could be marginally overweight large cap, marginally underweight mid cap, and small cap. From equity point of view, we are excited to launch our banking and financial services fund. It is open for subscription since 6th of Feb. It will close for subscription towards Feb 20th. This fund allows you to participate in the growth story of banks, NBFCs, and other financial services firm. This is compounding story, and clearly BFSI is the engine of the growth. Every business to grow will require money and hence give contribution to banking services space. On SIP or STP, it's time to pursue them with a longer term view because next 12-18 months could be very choppy. While there are lots of newspaper report which is showing that funds are underperforming their benchmark index, we can show that across, there is some error in this data. My apology, we would not have added this kind of alpha. We need to check this slide. My apologies. Let's go to next slide. On the SIP, we continue to add value to our investors by outperforming benchmark indices, and those funds where we are still not outperforming benchmark indices, we expect to recover quickly. In hybrid fund also, we continue to add value to our investors by outperforming benchmark indices. We have been highlighting our tortoise and hare fund, where funds go higher like rabbit and comes down like tortoise. Kotak debt hybrid and equity savings has an upside downside ratio of almost 4, whereas multi-asset allocator and balance advantage fund has upside downside ratio of 2. For conservative investor, this is the best opportunity to participate. One of the fund which has done extremely well over last about 2 decades is Kotak multi-asset allocator fund. It is kind of fill it, shut it, forget it kind of product. And lump sum investment of 1 lakh since inception has grown to about 15 times more at 15 lakhs in Kotak multi-asset allocator fund of fund dynamic plan. One of our large fund, Kotak Flexi Cap, had struggled in the past for few quarters, but now we are glad to say that it is coming back and it has already recovered some of the underperformance of the past. Kotak Tech Saver Fund is the Harfan Maula Fund for Tech Savings. And those people who want to stay in old tax regime, this is one convenient way of investing with the dual advantage of taking tax advantage. On gold, central banks bought more gold than any other year in almost last 50 years. Clearly, they are learning from Russian central bank experience, where their securities were frozen when they invaded Ukraine in global markets. Gold prices also benefit when US interest rate starts coming down. In the past, whenever interest rate cycle turned in US, gold prices appreciated, moved up. When you are investing in gold in Indian rupee, please be aware that there is tax incidence of about 18%, including 15% import duty on gold. In simple terms, what you buy for $100 in Dubai and Singapore, for the same gold, you pay 118% in Indian market.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.